Okay, good afternoon all. Thanks, Joe, for your kind introduction, and a warm welcome to all of you. So, as Joe just mentioned, I've recently joined VimpelCom in early November, and I've since learned a great deal about the potential of the business, and I'll share many of those insights with you today. However, I want to start my discussion with my view of finance as a function and how I see finance contributing to the value agenda. So fundamentally, I think that the role of finance is to create shareholder value. Now that sounds obvious, and I'm sure all of you agree with that, but too often finance is actually much more focused on just protecting and preserving existing value rather than actually creating shareholder value. To create value, finance has to get involved in influencing strategy and involved in commercial decision making, and in order to do that, it needs to be robust, confident, and commercially and customer focused. I'm now going to discuss some of these attributes in a bit more detail on the next slide. So this, in different forms, is a slide that I've carried around with me for over a decade and a half. And it's a philosophy which I continually practice and preach. In my view, the role of finance is to provide proactive support to decision making while remaining the steward and conscience of the business and its assets. So what does that mean? Well, obviously, we have to be able to do the basics really, really well, from both an effectiveness and an efficiency perspective. So that means complete integrity in transactional processing, the reporting of results, and the safeguarding of assets. In addition, we must be able to develop, maintain, and monitor robust systems of internal controls. Okay, but just as the foundations of a house are pretty invisible to its occupants, these values and these attributes should be so well ingrained in us that actually they're largely transparent to the rest of the business, and the business should have complete confidence in our capabilities in this particular area. So then you move on to business partnering and being able to influence decision making. So clearly, we need to be able to see other functions as our internal customers, but we've got to earn their trust. We can only do that if we show that we are customer-focused, credible business partners who challenge constructively and impartially and actually provide alternative solutions rather than just putting up a stop sign and saying no. We've got to be able to mirror and drive the culture of the business, be analytical and data-driven in our approach, and finally, and most importantly, and most relevant for today, we've got to be able to make those tough decisions and be accountable for them. In summary, to be a real, true business partner, we need to have a delicate balance of being a policeman, a coach, and a supporter, sometimes all at the same time. Clearly, communication with the markets is very important to us. And we need to be open and transparent so that we share with you all of our news at the relevant moments in time, whether it's good or not so good. So here at VimpelCom, it's clear already that we have a pretty strong finance team that works well across the group and within the business units. However, we've still got some room for improvement. We can significantly improve both our effectiveness and our efficiency by standardizing and streamlining all of our core processes, for example, by implementing global reporting platforms and similarly integrated planning architectures, potentially even with greater utilization of shared service centers. So in finance, I know we've got some great people with real passion for the business, and I'm confident in our ability to play a leading role in creating shareholder value. So let's now turn on to our historic financial performance. Over the last 3 years, we've had decent, profitable organic growth. And in total, the group has increased its revenues by 3% on average and EBITDA by about 2% on average. However, if you just focus narrowly on the emerging markets portfolio, you actually see much stronger growth rates of about 5% on average on both of those metrics. As Joe has already mentioned earlier, in 2013, our revenue and margin trajectory stalled as a result of macroeconomic conditions and regulatory issues. In fact, due to the severe intense price competition and MTR reductions in Italy, we've actually experienced margin declines there. Cash flow generation, while remaining strong, has declined in the last 12 months, both due to lower margins in Italy and increased investments in some of our emerging market assets. So if you look at margins and compare with our peers, you can see that we develop or we generate significantly higher EBITDA margins than most of our global peers, which is testimony to, as Joe mentioned earlier, to the operational excellence program that we have in the group, coupled with the ability that we have to derive synergies. So if you look at how we add value as a group, one of the greatest benefits that we have as an international, diverse telecoms operator is our ability to scale. You might recall that as a result of the Wind Telecom acquisition, we generated $2.5 billion of NPV in synergy benefits from that. In addition, as Jan Edward showed last year, in certain instances, we've been able to generate 50% price reductions on equipment procurement, both as a result just of larger scale and also other procurement synergies. We've also established a centralized procurement function to benefit from the scale, and in many instances, we now get far better prices than our local competitors from global suppliers. As an example, we've recently signed contracts for USB modems, IT infrastructure, and other billing platforms, which have yielded 15 to 25% savings versus prior contracts. As Joe's already shared with you, we've signed a considerable amount of global partnerships, Microsoft, Google Play, Opera, etc., and most recently WhatsApp, all of whom are attracted to our diverse portfolio of assets. Centralization of roaming contracts has yielded tens of millions of benefits in 2013. And finally, we're attracting top talent to the group, and we're able to develop that talent by rotating it across our footprint so that they learn from diverse experiences and can grow their careers. So, sharing best practices is something that I find that VimpelCom does really, really well. And we've got many examples, and I'm just going to pick out a few of them for you today. So, sharing experiences on MNP implementation from markets as diverse as Georgia, Italy, and Pakistan has informed the MNP program that we've developed for our Russian business unit. The learnings from our 3G and LTE launches in our more mature markets are now being deployed in our planning for similar launches in the less mature markets. Improving our customer experience programs in Ukraine and Pakistan by leveraging learnings from Russia, and final example on this slide, incentive schemes for our corporate sales teams that were originally developed in Ukraine are now being deployed in Algeria and Italy. So let me now address what we've achieved since last year's Analyst and Investor Conference in the way of financing savings. So we've executed the first internal funding flows via the in-house finance company, which has delivered tens of millions of P&L benefit in 2013. As announced with the third quarter results, we've increased the distributable reserves of OGSC VimpelCom in Russia by about $3 billion, which will provide further funding for the in-house finance company over time. And lastly, working capital improvements. So although we have a very cash-generative working capital cycle by virtue of the fact that we're primarily a prepaid business, we still saw value in launching a pretty big project on that in 2013. And through the first 9 months of 2013, we actually delivered a 10% further improvement in working capital. And we aspire to more in 2014. So some of the things that we have done or are doing there would be optimizing payment runs, integrated sales and demand planning, just improving terms and conditions with vendors, aligning payment terms, optimizing handset inventory, and just focus on improving receivables. Finally, as you may recall, we've secured external funding of just over $2.5 billion in the early part of 2013 at an average cost of roughly 6.25%. So you might remember this slide from last year when we first introduced the concept of an improved funding model for the group. The word in-house bank, which was used at the time, was a little confusing to some. They thought that we were actually going to lend to other corporates. All we meant by it was that it was going to be an internal financing company, which is common to many other multinationals. The principles behind it are actually relatively simple. We just use the dividend flows from our cash-generating businesses to fund our Luxembourg-based in-house bank, which then funds our CapEx programs across the rest of the group. And over time, our goal is to move more and more funding towards this optimum model. To date, we've already provided $1.7 billion of funding internally via this model through the end of 2013. The model will ensure optimum capital allocation within the group and also enable tax optimization. Today, our effective tax rate is in the mid-30s, which is much higher than most multinationals. And through utilization of this model, we'll get that ETR down closer to the levels that you see in other multinationals. And to give you an idea of the size of the prize, just purely from a tax perspective, every $1 billion of funding that we flow through this model yields roughly $15 million per year of annualized cash tax benefits. We also believe that our financial profile can be improved. Currently, we need to maintain our BB rating, but over time, we want to improve this either to BB plus or BBB minus as we both delever and generate increased operating cash flows. Clearly, we have an intent to delever to less than 2 times net debt to EBITDA, at which point we're probably going to become investment grade, and that then will allow us more flexible access to funding and capital markets and a lower overall cost of funding. Last year, we provided financial improvements or potential improvements in cash flows from financing activities. So we still believe that the savings and the benefits from the last 3 categories are broadly achievable in the same way, in the same quantum that we described last year. However, the savings from the in-house finance company are very dependent upon Italy. Conservatively, to the extent that Italy remains self-financing, the savings from the in-house finance company would be approximately $50 million per annum. And under that scenario, the total amount of financing savings that we could generate would be roughly $400 million per annum. So as Joe discussed earlier, Wind Italy remains a valuable asset for the group, and we intend to unlock that value. Our decision regarding value creation in Italy depends upon the macroeconomics, the competitive and the market situation and environment, our operating performance, and the potential for financing savings that we see. So we see significant savings if conditions are right, but as Joe said, we are going to make all decisions based on what we think is in the best long-term interests of the group, and we will not be influenced by any short-term factors. So let's turn to the dividend. Our track record of paying dividends has been very good, supported by strong operational cash flows, coupled with the prefs conversion in April 2013. We've returned $5.3 billion in cash dividends to our shareholders over the last 3 years, including an interim dividend of nearly $800 million at the end of 2013. Returning capital to shareholders is fundamentally important to us, but so is ensuring that the business is supported for future long-term growth. Based on my prior experiences, I'm a very strong advocate of the need to invest in high-speed data networks to capture future growth potential. And that, coupled with the need to delever, means that we see more long-term value in cutting the dividend and revising our dividend policy to support that future long-term growth. So our board made the decision to implement a new dividend policy with immediate effect for the right reasons. We will not be paying a final dividend for 2013, and going forward, as Joe's already mentioned, we will maintain an annual dividend of 3.5 US cents per share until we reach that target leverage ratio of 2 times net debt to EBITDA. So let me wrap up. I see clear opportunities for finance to contribute greatly to the value agenda by optimizing our operating models and structures and just being generally more influential in strategy and in decision making. I've also given you some clear examples of how we unlock value from being a large international telecoms operator. Despite the difficult environment that we operate in, we still generate robust margins and solid cash flows. However, today we've announced a tough decision to revise our dividend policy to support deleveraging and to be able to invest sufficiently in high-speed data networks, as we think this creates the best shareholder value in the long run.